Good morning, ladies and gentlemen. A very warm welcome back to you on Business Today Television. This is a day where bears are having a very strong hand on the Lal Street, but also an opportunity to get into the market at a lower price, as also into a very important sector, banking and financial services, at a time when tailwinds are very strong. In our Market Guru series, we get you to meet some of the finest professionals on the Lal Street, professionals who've made money in all sorts of markets. And today it's our pleasure to welcome Mr. Yogesh Patil, Chief Investment Officer for the Equity Business at LIC Mutual Fund. Mr. Patil not only manages several funds at the PSU Mutual Fund AMC, but is also a very strong hand when it comes to the banking and the financial services space. Patil Sahab, namaste and a very warm welcome to you, sir. How do you see the market at this point of time? We've had a very strong rally and an equally sharp correction. What are the positives on the Lal Street at the moment?
See, definitely, equity investment is a long term. It's like an infinite game, where we need to face a lot of challenges in between. It is unlike a finite game where you have rules and time horizon defined. So, first priority of any investor is we should be remain game and try to adjust whatever changes possible, and accordingly we need to adjust. So currently, in last 4-5 years, we've seen a good rally. Last 1 year was little subdued, but coming, if you ask me for next 3 to 5 years, so India equity market looks good because there are a lot of sectorial changes, structural changes already happened. I'll tell you first is macro, where interest rates continue to be low from here, considering debt to GDP, considering current account deficit, and considering inflation. So these are the major part for equity market, because interest rates are basically inversely proportional to the equity market valuation. Now, if you see the growth drivers as well, and there are structural changes and call taken by government, it is actually supporting the growth that includes your consumption as well as investment in selective manner. For a broad base, it might be growth around 6 to 7%, and nominal could be around 10 to 11. But if you see the stock specific or sector specific, growing still higher than nominal GDP. So overall, we are bullish on market because there are structural drivers like investments. We see good investments coming from power sector, power T&D, data centers, EMS space, and specialty chemicals. Those are the major growth drivers. And followed by in discretionary consumption has shown a really drastic growth. In last 10 years, overall consumption just grew by almost 10 to 11%, but discretionary was higher compared to essential, between 13 to 14, and this trend is increasing again and again. So India is heading for a capex boom, and majority of the industry is going to benefit from here, because we are also offering actually some solution to global investor. In last 20 years, India was nowhere either in EMS or engineering anywhere. But today, India is actually reaching somewhere where we are in discussion with export market share, and so many businesses, new opportunities here because of either China plus one or maybe domestic Indianization, import substitution. So these are the major portion where the manufacturing boom will take place, and financialization, upgradation, improving per capita income. In the overall basis, we are positive, and Indian market can actually we can see a double-digit kind of CAGR growth for next to 5 years. It is not look impossible to be because of the strong macro trends. We have a strong demographic population where working age population is only available in India, and where they can consume also. So if you put all these things and considering the global position, we are very good in defense. We are quite diversified. We don't have to worry about any major external shock. Earlier used to be, because historically large part of the current account deficit was were funded by FIs and FPI. But currently, considering the crude oil impact import as a percentage of GDP is drastically reduced today. So there the comparatively volatility is reduced, stability is
Right,
improved.
sir.
We don't see any shocks.
Right. Let's look at the performance of the last 1 or 2 months as far as LIC mutual fund, the equity part is concerned. Uh, what are the fresh positions that LIC mutual fund has taken in the equity space, and where have positions increased? I have data for the month of September and October. Banks is something that you have really increased your positions in. All the four top private sector banks, HDFC, ICICI, Kotak and Axis, including State Bank of India. What is the logic on being long on both the PSU and the private sector banks at this point of time?
Obviously, NPA cycle we see almost lowest in last 10 years. The credit quality has improved, and the sector valuations actually very attractive compared to last 3 years, and the sector has not performed. And we see some pickup in credit growth. Is largely driven by consumption demand, not exactly industrial or corporate banking. And future for next 10 to 20 years, we see again the banking will be driven by consumers. Consumer banking will be a major growth drivers. And any bank, any franchisee offering a very good customer service or maybe a convenience to customer, those banks supposed to be the good banks in terms of growth. And the interest rates are in favorable zone. Inflation is in benign mode. So next 2 3 years, if macro is good, environment is good. In fact, the profitability, quality of profitability is increased in last 2 years, and uh, profit as a percentage of overall GDP is also increased to around 5% in last 2 years. So these are the healthy indicator. It means overall economy is in much better shape. Balance sheets are basically debt to equity. Almost, if you see the major corporate ratio, except certain infrastructure companies, is almost 15-year low. It means there is no major shocks available in banking. Plus, environment is healthy. There is a sharp improvement in the credit quality and assessment by BFSI segment, and is again regulator is closely monitoring and following and taking action whenever it finds this need to take it. So environment is good. Growth is obviously incremental GDP. Growth can be captured by BFSI segment also. Let's take it because is it historically nominal GDP and credit growth could be almost similar, and we see at least this much of double-digit growth is possible, and valuations were attractive. So these are the major points.
Right. Okay. Mr. Patil, when you look at the NBFC space, this is also showing a very smart traction because of the tailwinds that we have earlier discussed. What are the 2 or 3 major NBFCs that are in the portfolio of LIC mutual fund on the equity side, and how do you see this sector?
Definitely, but I'm sorry, no, we can't disclose the stock name. So I'll tell you about how we see the sector basically, specifically from here. There are good companies in NBFCs where we see they have good understanding in terms of macro environment, MSME, SMEs, they're good in that, and their liability franchise is much better. So these are the major criteria while we selecting the NBFC, and because here promoter quality and assessment and plus your liability matters a lot, and incremental growth could be only captured by those NBFC where they have a sufficient capital, sufficient manpower and system in place to capture these growths.
Right, sir. Let's look at spaces that you have avoided in the top 20 stocks that I see in terms of market value. There is not a single IT company. A reason why you are avoiding them?
We do have a IT companies, but we are underweight in most of the funds. See, reason there's still lack of clarity on spending on IT, and the direction of spending is completely changed towards IT. Sorry, no, AI. I'm sorry, AI and other new technologies, where some of the Indian companies are not present, and any company is present, there as a percentage of revenue is still low, and there's again a lack of clarity on margins here, basically, because in last two results, most of the companies gain business momentum because of the cost takeout deals. And whenever you have low growth and cost takeout deals, it means margin has to sacrifice from here. So these are the major criterias when we thought at least we don't have clarity, and in cost takeout deals is a very long-term business with a low margin. So we need to see some traction. As of now, the one good part is no corporate has actually given any negative commentary. Everyone is a stable and neutral kind of thing. But we need to see the, because world is changing very quickly, and how our Indian companies who were not largely invested in IPs and new R&D, they can capture the technology boom from here. So we are worried on that part also.
Okay, so that's the view as far as markets are concerned. Apart from banking and financial services, Mr. Patil, what are the two or three other sectors that LIC Mutual Fund AMC is bullish on?
So we are also bullish on industrial and capital goods, where we see, because India is heading for a big capex, especially in power data center. Let's take a data center capex is going to be almost for 3-4x in next 5 years because of the requirement from regulator and the existing demands. Even at the global level, export companies are doing very well. Indian capital companies do the serving data centers part. Same with EMS space. Third one is basically defense indigenization, and defense companies also showing a very good potential. So we see, and this total capex for power, defense, EMS, including data center, we see almost for more than 1,25,000 crore of capex for next 5 years is going to be a spend on selected industries, including specialty chemicals, CDMO, and oil and gas. And these are the sufficient to drive the Indian GDP growth drivers from here. And this is, and corporate balance sheet is in much better shape. Quality of profitability is improved, and we do see that because of the recently GST cut and tax incentives given by government. Obviously, once the demand will pick up, there will be a lot of investments in supply chain, logistics, e-commerce business, and at the same time in manufacturing as well, because some of the capital goods companies also serving these parts also. And we do have a very good consumer market, but still we are more than 90% we are importing. So there is still room for import substitution in defense and EMS space, and even in specialty chemical and pharmaceutical. So these are the major growth areas
Yes.
we do see drivers for Indian economy. At the same time, there are domestically lot of changes. Let's take a financialization of system, overall system, because of the UPI transaction, the productivity is increased. At the same time, uh, because of the higher productivity, you can do transaction much better.
Right.
So these are
Mr.
the new
Patil,
trends
the
where they
two
need to
defense
contribute to
plays
Indian
overall.
GDP. Sorry.
Right. Mr. Patil, the two major stocks representing the defense space within the LIC mutual fund portfolio is BEL and Apollo Microsystems. Broadly, how do you see this sector performing, and any other shipbuilders or aircraft makers or the private defense space, anything that you find attractive apart from these two?
See, we are continuously looking this sector very closely, but this currently this sector is not actually getting a good valuation entry at this point of time. But we need to look at the indirect beneficiary, either in terms of supplier, vendors who are indirect beneficiary. And we do see a very strong momentum in indigenization, especially on electronics part of the defense. So we are positive on overall defense as well as especially on electronics, where do we see the dependency on other countries has to reduced. That's the main criteria of the government, and that this will reflect in the coming years of spending on electronics. So we are bullish, but at this point of time, we cannot discuss any names on this platform. But especially in electronic side or and which caters to defense, we are positive.
Okay, fair point. Let's look at the AMC, the capital market space, where as a representative AMC of a market that's growing dramatically well, many AMCs are also getting listed. Your former employer Canara Robeco got listed 2 months ago. Through ICICI is also in the process of getting listed. How do you see the capital market space at this point of time?
See, we are very positive, and because if you see historically, India has changed in last 20 years, and from I think 2015, the household equity exposure was somewhere around less than 3%. Currently, is 7 to 8%, and at least I am not comparing US and other countries, but considering the India's DNA of entrepreneurs, so we do expect either they might be engaging directly in their own companies or maybe listed equity. Because historically, apart from gold, equity is the only asset class where they shown clearly the benefiting because of the higher inflation in long term. At same time, and equity related business like AMCs, like in capital market participant, like any broking companies, even depositories or exchanges, all going to benefit in long run. But is also again we need to check here the how the competition is playing in some of the segments. But long term potential looks very attractive and good at this point of time, considering the low penetration in Indian economy, and because of the historically India was very good in generating new business, just it is changed. So because of the mindset and those who can actually build their own company and family businesses, and they can list or either startups, and those who can't do, definitely they will be a buying or taking exposure from listed space or either from mutual funds on some other platform. So potential looks good from here, from our side.
Okay, my final question, Mr. Patil, is how do you see the market 1 year from now, and what are your targets on the Nifty and the Bank Nifty, sir?
It's very difficult to give target, but we do expect roughly, I think, at least 30 to 15% kind of return is possible in Nifty in 1 year, considering the valuation, considering the earning growth, because earning growth normally Nifty follows the earning growth path, and currently Nifty EPS growth could be roughly 13 to 14%. So similar kind of trend could be visible in returns as well. And same with the banking, like 15 to 17%, where we see a BFSI segment is again attractive in terms of valuation, in terms of profitability growth, and improvement in overall credit growth as well. So both seem supposed to be follow the earning growth, and earning growth looks good at this point of time.
Ji Patil Sahab, thank you very much for this wonderful interaction on what the thought process for equity picking at LIC Mutual Fund is. Have a great year ahead, and the very best of luck to all your unit holders. Thank you very much for your time.
Thank you very much, and thank you for hosting.
Thank you, sir. That, ladies and gentlemen, was Mr. Yogesh Patil, Chief Investment Officer for the equity part of LIC Mutual Funds Asset Management Company. Please continue watching Business Today Television. There is a lot that's happening on the other side of the bed.